Aoifinn Devitt, CIO at Moneta, and welcome to this Moneta moment where we are going to discuss investing in infrastructure. Infrastructure has been on many people's minds recently with the recent passing of the $1.2 trillion infrastructure bill, which is designed to upgrade aging infrastructure such as in roads, bridges and other transportation infrastructure. The spending will be over the medium-term period and will foresee public and private partnerships. Infrastructure tends to have both explicit and implicit inflation exposure. There's also a global opportunity set, with some areas having a steady cash flow yield and defensive equity-like exposure. Energy security is of course of prime importance today in light of soaring demand and prices, as well as responses to threats of climate change elicit new technologies and a transition to more renewable sources of energy and electric vehicles. Infrastructure is a very broad universe and includes exposure to transportation, communications infrastructure, energy infrastructure and utilities. These sectors have varying exposure to inflation and varying exposure to growth of GDP. Over the long term, we have seen that global listed infrastructure tends to behave like defensive equity. It will therefore tend to underperform in strong equity markets. It also tends to outperform in periods of higher inflation, as this chart shows. This chart looks back over 20 years, and we can see that over all periods, the S&P Global Infrastructure Index, indicated by the green bar, has slightly outperformed the mainstream equity index over the whole period. It has significantly outperformed that index over periods of high inflation and slightly underperformed that index over times of low inflation. Over all periods, an exposure to global infrastructure outperformed an exposure to bonds. The other advantage to an infrastructure allocation is the exposure to cash flow or yield. As can be seen in the next chart, the yield of the Global Infrastructure Index has consistently been higher than that of mainstream indices. So what are our key takeaways from this Moneta moment? The world is experiencing a period of higher than usual inflation, with recent end-of-year inflation prints close to a 39-year high. We believe that portfolios should include assets that have historically been inflation resilient in order to avoid the loss of purchasing power. Infrastructure provides defensive exposure. It will have some equity market correlation, but it tends to have a higher income and better inflation protection than mainstream equities. A broadly diversified exposure to infrastructure will provide exposure to themes such as renewable energy, battery storage, transportation and communications infrastructure. Exposure to infrastructure can be obtained through a wide selection of solutions. These include infrastructure debt, infrastructure equity and listed and unlisted vehicles. I'm Aoifinn Devitt and thank you for listening to this Moneta moment.